Hello, welcome to Aasgard Updates, episode number 7. This one's entitled, Get Off My Lawn. They say if you live long enough, you get to see history repeat itself. And I believe we're in that moment. And it's like, I've seen this all before. And it makes me angry that people are making the exact same kind of decisions and mistakes that might have been made before. And then, of course, there were consequences to those mistakes. So I'm like worried for a whole bunch of people. Anyway, we're going to discuss a lot of that today in this video, at least my opinions on it all. If you find yourself in this channel, you might be wondering where the heck you are. This is basically a communication medium for myself. I'm the manager of the Coldstream Dividend Growth Strategies and the Aasgard Small and Mid Cap Fund. And so some caveats before we begin. First off, this is not personal financial advice. If you need personal financial advice, please talk to a financial advisor. In order to give personal financial advice, a good advisor is going to need to know about your balance sheet, your income, the sources of income, the sensitivity of that income to the economy, all sorts of factors and things that are good in preferences in order to give proper financial advice. So please don't take advice from strangers on the internet or on YouTube. And secondly, this is not a solicitation for investment. So with that, let's get to the topic at hand, which is the stock market in a bubble? So let me change up my screen here. I'm going to go to a stock chart. This is the S&P 500 for the past 3 years, basically how I start off all of these things, but it gives you a nice good context. We've been on just this bull market tear basically from the bottom of last year, and we're almost about to lap the 1 year mark on when this whole COVID thing started and the recession started. Basically, since last December, the market's just continued to go straight up. And we've had a little bit of a correction over the past week, but we're talking like 3-4%. This is, in the world of corrections, this is minimal. You can see we're basically sitting at our 50-day moving average right here. So still a super strong bull market, and various segments are starting to bubble up. The focus of the last video was a rotation into value stocks. We saw, quite a bit of price momentum coming back into energy stocks, and basically all the beaten down stuff, your casinos, your airlines, all the things that were really, really, really super cheap started to come back. And then basically this year is a new phenomenon, and I won't go too far into it, but the whole Reddit phenomenon with GameStop and basically, the most shorted stocks on Wall Street. Basically, there's a crowdsourcing scenario going on where you have a bunch of kids on Reddit that are buying the most heavily shorted positions and really creating short squeezes. There are plenty of resources out there if you want to go look into that. Maybe I'll make it a topic for next time, but I really want to talk more just basically in aggregate, like whether or not the market's in a bubble, how we should think about that, and how we should be thinking about investing in a market that seems to have very excessive valuations. So let me share a chart here. Get my face out of the way. All right, here we go. This chart is the case. This is the Shiller PE. So what it takes is the trailing 10 years worth of earnings relative to the current price of the S&P 500. And this goes all the way back to 1880. And you can see the various bubbles we've had in the past. So this is the roaring 20s all the way up to Black Tuesday. We got to a Shiller PE of 30. And then we had the Depression. Then we had World War II. And then we had a period of very high interest rates. And then we finally got into the 90s. And you can see in the late 90s, this Shiller PE went all the way almost nearly to 45. And as of today, it's starting at 34. So basically, we're at the valuation range that we've seen basically back in 1999, and also back in the roaring 20s, right prior to those bubbles bursting. So is this a bubble? Well, I've got to tell you, the market is terribly expensive relative to its own history. But as investors, you don't invest in a vacuum. You don't say, this is a good value, I'm going to buy this. So what can I do with my money? Where am I? And as an investor, you can choose. You can stick it in cash. You can buy the bond. You can buy the bonds, or you can buy stocks. Well, if you look at the bond market's even more expensive. So move my face here again. What we're looking here is the 10-year Treasury rate. And so this is the rate that you can get on a 10-year bond from the government. So there's basically no credit risk. And you can see this peaked This time frame goes back to basically, like, what is that, 1950, 1962. And you can see it peaks there right in late, with the 1981 at a 10-year treasury rate. I love these rates. I probably wouldn't have liked them back then because the prevailing inflation was so high, but basically at 15.84%. That's a very high interest rate. And you can see over the past 30 years or so is that interest rates have just been falling and falling and falling and falling and falling until we get to this point down here. During the crisis last year, we saw the lowest interest rates on the 10-year ever. And we've rebounded a little bit, but still, what's the last tick on here? 1%, a little bit over 1%. Prevailing inflation is about 1.7%. So this treasury rate that we're looking at pays you less than inflation. Well, any kind of reasonable investor is going to look at that and say, that's not a good deal. I want to make at least inflation. So I'm going to go take my money and invest it somewhere where it's going to earn more than that. And if you look at the stock market, well, relatively speaking, it's actually not such a bad deal. And I thought it'd be interesting. You can flip this treasury rate into something that you can maybe kind of apples to apples, right? If you're going to look at a PE ratio, well, let's look at the PE ratio that you're going to see on a 10-year treasury. So pay $100 for the bond. What's the interest rate? You divide 100 by the interest rate, and that's going to give you a bond PE for the 10-year treasury. And you can see, again, the nadir down here is at a 6 back in at the end of 1981. And then you can see steadily, as time's gone by, basically bonds are trading about 40 times interest, over the past, I don't know, basically the modern era since from the financial crisis. That ratio has been hanging out around there. Of course, it spikes up and on the highest level ever back in the middle of the pandemic, where the forced closures were going on, and the market was basically freaking out last March. And it's come back, like I said, it's come back a little bit. But basically what you're looking at now at a 1.07% interest rate on the 10-year is you're looking at 90 times interest, right? Well, in the stock market, you're paying 30 times interest or earnings. And so in that sense, the stock market's relatively reasonably valued relative to bonds. And so that can explain a lot of the behavior that we're seeing. And it can also explain why valuations can keep going up. So where do we go from here is the question here. Let's got another point I want to make here on my PowerPoint. But basically, like, who's in charge of the market, right? Like who's setting, this is basically a sociological phenomenon, pricing in the market and what people are willing to pay. And so the concept I like to think about is this marginal pricing actor, like who is in control of the pricing of a particular security. Now, historically, and through most periods of time, at least in my professional life, the actors that are in control are these, basically the professional investor class. And so these are people like Benjamin Graham and Warren Buffett. And their style of investing is to look at a business, look at its earnings, and say, what is this business worth, right? And you can do what's called the DCFs, the discounted cash flow analysis. And you would basically sum up all the earnings you expect that business to earn, or dividends, if you want to do it that way, and sum them back to the current value. And you can discount it by prevailing risk and the perception of risk and prevailing inflation or whatever the risk-free rate might be. And you can discount that and you come up with a value, right? You say, okay, this business is worth X, and I want to pay X minus 1, right? I want to pay a price lower than that intrinsic value. And so generally when the stock market's crashing, and then all of a sudden you see people stepping in, those are investors. Those are your classic value investors. They're valuing a business and say, my goodness, this thing's crashing and it's trading at a very, very low price. And so I'm going to buy that. And that's how I was trained. I mean, you do the chartered financial analyst or do an MBA, that's what they're going to do. That's they're going to teach you how to value a business. And you can do peer group valuations and all that kind of stuff. But generally, you're looking at discount cash flow analysis. And then you've got, when you look in the financial press, there's another class of investors or trader out there, which I'll call them the traders. And this is like your Jim Cramer, right? You buy gold, sell Pepsi, whatever. Any given day, what they're principally using to decide what stocks to be in, they're looking at momentum. And they're basically saying what's working today. I'm going to own what's working today. And if it's not working, I'm going to sell it and get rid of it. And and then when it's working tomorrow, I'll buy it back then. And so they're continuously turning and turning and turning. These are basically the prop desks on Wall Street. This is like your classic Wall Street. You've seen those pictures, and there's a whole bunch of traders at their desks. Those folks are trading on momentum, and the measures that they use, they're unique to each individual. But generally what they're looking for is positive price momentum in the stock price, maybe some news narrative change, maybe something is inflecting in the business, and they're looking for that rate of change. And they're going to have, technical indicators and that kind of stuff, stock charts, kind of some of the stuff I like to look at. And they'll use it in trading these stocks and deciding when they want to be in and out of something. And then you get the retail investor. Now, in certain points in history, the retail investor is the swing actor in pricing securities. And the last time we saw this, I saw this was late 90s. This was the dot-com bubble craze. Your average Joe deciding, what, I'm going to get in on this stock market thing. Those professional investors are making a ton of money. I want to get in on this, and I understand it because I understand the internet's going to change the world. So I want to be a piece of this. And so I've got the little bullet point on here. But these are your amateur investors. These are people that find it up as a hobby, or some even take it up on themselves to make it their own personal profession to trade stocks. And they all are going to come up with their own kind of ways of doing that. But generally speaking, they're looking for a narrative, right? And I got the list there, but the comment there from these kids on Reddit, right? I don't know if they're kids, but I think that the perfect analogy, like these kids, call them 30 and under or 40 and under, what they're doing is rating lately on this whole GameStop thing. It's amazing. But when they were playing games 10, 15 years ago, computer games, World of Warcraft and all those other kind of things, they'd all get together on Instant Messenger, and they'd all talk to each other, and they'd coordinate their actions, and they all get together and they go raid the enemy. Well, they're doing the exact same thing to Wall Street right now, and I find it hilarious and funny and engaging, and I love the heck out of it. I love seeing these the professional investors in the shorts that, they'll take a position, they'll write up a big position paper why this company's dirt and why it should go out of business. There's a business is just trying to make it on their own and do their best to make money. And then you've got these activist investors that come in, you're terrible at your job, and I'm going to go bash you on social media and go bash you on CNBC. And then, of course, these kids come in, they find all these stocks that are the most heavily shorted stocks, and they're just beating the door out of these sectors. So I'm having a field day with that. Love you guys. Love you kids on Reddit. Thank you so much. But generally, when the retail investor is in, they're looking for a narrative. They're looking for, like Tesla, right? I'm going to change the world. I'm going to, Elon Musk, he's building rocket ships, and he's electrifying the auto fleet, and they're selling cars that no one thought could be made. And that's a big narrative change. These investors, unfortunately, are not doing any sort of valuation analysis. They're not looking at the stock and going, what, I'm going to sum up, they're not putting together a spreadsheet and summing up the value of that business and then deciding, $200 is a good price, $300 is a bad price, I'm not going to buy $300. They're just like, look, it's $850. I'm in. I like Elon Musk. I like his tweets. I think he's funny. And I also think he's changing the world, and I want to be a piece of that. And so right now, that's where we're at. The retail investor is in charge of many segments of the stock market. I started to try to compile a list of these things, but when it came up with alternative energy, go look at the stock chart of any kind of solar or clean tech firm. They're all skyrocketing to the moon, infinite valuations, electrification of cars. I mean, you name the car, you name the electric, anything that's building components of batteries or electric cars is getting a bid right now. Cannabis stocks, marijuana stocks, all those things are catching quite a bid. There's been a change in our government, and potentially there might be legalization on the way. And so, but that's something people are finding attractive. These SPACs, which are basically shell companies, I mean, not a shell company, but it's a business that, that has raised money to go out and acquire a private business and then make it public. I think these things are fraught and ready for fraud because there's just not the layer of diligence that you have in a regular IPO. And there's not the pricing discipline that you'd see in a typical IPO or even in private equity, right? They're basically taking companies that really should remain private or would never really transact in a private transaction, but they're selling it to some sucker. I mean, basically when you're buying an aspect, what they're saying, these public shareholders are the sucker. I don't know if you've heard the term before, but if you don't know who the sucker is at the table, it's probably you. And I think a lot of the investors in these SPACs are going to get burnt by overpaying for maybe a decent operating business, but they're going to overpay for it, and the company's never going to justify its valuation. And I'll show you some stock charts of past companies that have actually been successful, but their stock prices haven't even recovered, or took a very long time to recover. What else is going on? Blockchain. So anything related to Bitcoin, Ethereum, and all that kind of stuff. Again, big, massive narrative. We all know blockchain is going to change the world in some sort of value, but we don't know who the winner is going to be. We don't know if it's going to be Bitcoin or some other coin that's easier to transact and build transactions around. It could be anything, but everyone knows it's new. Everyone knows it's going to change the world, and everyone wants a piece of it. So they're bidding it all up. So what's the problem with buying all these narratives? Well, it doesn't work out. This is where I'm like, get off my lawn, you poor kids. Yeah, I don't want to see you lose your fortune. And so basically what I'm saying is know the game you're playing, right? Like if we're in a bubble, make the rules and decisions that you're going to make based on that line of thinking. Like, look, these are bubble trading. You're at the casino. You're wagering at this point. So let me pull up some stock charts here of some past successes here. So here's Qualcomm. So this is a real long chart, but this is a stock chart. Qualcomm, successful business. They make chips, go on your phone, communications equipment. Darling of the 90s. Everyone knew the future of the internet. The future of internet was in communications, and that these Qualcomm was going to be a piece of that, right? I don't think anyone envisioned the iPhone or anything like that at that point, but maybe Steve Jobs did. But everyone knew that Qualcomm was going to be a major player in wireless communications going forward. And so their stock, and I got to trade this. I was around back then trading this. I had my Netscape and Yahoo, and a lot of companies. Those two companies aren't around anymore. They just flat out don't exist. There's Enron and WorldCom that ended up essentially being frauds that came out of this period. We're probably going to have some equivalent come out of this. I don't know who. I wish I did. Short them, but here's Qualcomm, which is a very successful, very well-run, real technology company, right? They make things that exist. They have real customers and they have real revenues. And of course, their valuations went crazy. And so you can see it peaks there, right, in the early 2000s. And then you spend, if you bought in this euphoric phase, this late 1999, early 2000 phase, you were dead money for a decade. Now that's a long, long time to wait for your bets to kind of win. And this is a successful company. These guys they grew their earnings through this whole period. I think 2001, they might have had a negative earnings. Fantastic business, terrible stock price. Same thing with Cisco. So Cisco in the late 90s was the thing. Everyone knew that Cisco was going to be the backbone of the internet, right? They'd sell routers. Well, what do routers do? They route internet traffic. So if the internet's going to exist, we're going to need routers. Well, no, the game's kind of changed now. Everyone builds their own routers, and the technology's shifted a little bit. But the fact remains, Cisco is a good, successful business that is highly profitable to this day. You can pay too much for the stock price. Here it is. I don't know, what is that? Split adjusted, somewhere around that $60. They're at the high of the 2000. Again, you're dead money till today. Right? It's 20 years later and you haven't made money on them. It's been paying a dividend, but you haven't recaptured all the price loss. Maybe you might be breaking even on a dividend, but just the dividend. But that is a long, long time. And I think Cisco, to me, Tesla is Cisco, right? It's a company. They built an actual product. They have customers. They're taking some market share. They are changing things, but a lot of competition is going to come along, right? GM and Ford and everybody else is going to build a new electric car too. And then you got plug-in hybrids and you have all these other alternatives that are coming. Chinese are going to come in. They're going to undercut you by half, right? So even on batteries, right? Let's say you have some battery lead. Well, cool. Chinese are going to come in. They'll probably undercut you by half. And so there's a lot of competition is coming for that poor company. But it's still going to be around probably a decade or two from now, right? But here's your stock price. You have not made money for 20 years in Cisco. Now, a lot of people bring up, well, what about Amazon? Amazon has done a very good job. They're one of the large, depending on the day you look at, they're the largest business on the planet, right? Okay, well, in late 90s, everyone knew that Amazon was a big deal. Everyone thought, it was a big contest between eBay and Amazon. Same deal, boom, big bubble valuations, peaks in early 2000, two long, terrible years, 3 years of basically for that bear market, and then you're basically dead money in Amazon again, the best business, like the biggest, largest company on the planet at the moment, all the way into 2010, post the financial crisis. This is a company that I actually think, when I forget when they actually turned profitable, but it was only just a few years ago, I think 4 or 5 years ago. But through this whole time, they lost money, they existed, but man, that's a long time to be dead money. And it's very, very painful. And again, another highly, highly successful business. This is Microsoft, 20 years dead money. So all your high flyers today, they look fantastic. Everyone likes making 300% in a given year. But man, you can get stuck with this stuff. And I think, the rules to playing this bubble is basically, look, when the money's going up, it's going up. And then when the music stops, don't hold on to your delusions that it's going to go back, right? I think if there's one thing I could go shake my former self in 2001, it's like, look, you're in a bear market and it's not coming back. It's not coming back for 20 years. Your Amazon stock is not coming back for 10 years, right? Rather than just staying the course. And so that's when, that trader mentality has to come in at some point and say, look, well, what's working right now? And so maybe, pull back, some of this, narrative driven optimism and say, well, what's working, what's not working? To me, I think, the way this eventually ends is going to be in higher interest rates. We've had two bubbles in my professional career, and that was the dot-com bubble, and then of course the housing bubble, both of which were ended by higher interest rates. And so no one really knows quite exactly the mechanism or where we're going to get the higher interest rates from at the moment, but it's gonna come eventually. If we continue to get insane price dislocation in the stock market, Greenspan identified the stock market as a threat to the financial system and began raising interest rates to fight off what was expected for higher inflation, but also, the bubble in the stock market identified it as a bubble. And then of course, obviously fought the housing bubble as well. These bubbles can distort markets, they can distort the economy, and the Fed's charter is price stability. And so eventually, if we get back to full employment after this recession, inflation starts to pick up, they will start to normalize interest rates. At the moment, they've basically said they were going to get a spike in inflation this year as we lap the 1-year recession, the COVID recession, and then we're going to look past that and we're going to look to basically like wage inflation and that kind of thing. But we also want to get to full employment. So you got to get to full employment, then you have to have sustainably high inflation, and then the Fed changes its narrative, starts describing higher interest rates. And as that happens, bonds start to become more attractive. Again, new dollar comes in. If I can get a 4% 10-year treasury, that's all of a sudden attractive relative to a 1,000 or 1,500 PE ratio on a Tesla. Those are pretty extreme investment choices, but that's the idea, right? At some point, bonds become more interesting, and it also it has the impact of raising the cost of capital for businesses, right? So if you're borrowing to survive, right? If you're a business that doesn't have a lot of good high quality cash flow, good customers, then you're borrowing to survive. Your cost of operating your business goes up every time interest rates go up, and that same thing happens to individuals. So all of a sudden your credit card payments go up and you have to refinance your house at a higher interest rate. So eventually these higher interest rates will come in, the bubble will reverse. When those higher interest rates start coming, basically, I want to be long right now with the market. We're definitely in a bull market. It's like in this euphoric kind of phase here. But when the Fed changes their narrative, or we get substantially higher inflation and substantially higher in interest rates, the bubble will end. And the prices that people are paying for many of these businesses will start to come down. Don't deny it. Don't go into denial and just hang on. And that there's behavioral finance concept called loss aversion. Don't be the loss averter, right? Admit it, move on. There will be something else. Get back to that trader mentality and say, what's working right now? Or go back to even higher up the hierarchy and go, what does an investor find valuable at the moment? And go do some work and find value where you can. And so know the rules of the game, know the game you're playing, number one, and then know the rules of what you're playing. So good luck to you all. This conversation isn't too germane to the strategies that I'm running, because the strategies I'm running, I mean, the valuation, I mean, I'm in category one, back to that old slide, right? The businesses that we are investing in these strategies have lower valuations than the stock market in general. They have higher dividend yields. They have plentiful cash flow, customers, revenue, all those earnings, all those kinds of things that are pretty boring and only us old fogies like at this point. And that segment of the market is not at all in a bubble. Consumer staples and utility stocks are just not terribly sexy at the moment. And so if an investor wants a place that wants to find a type of that kind of strategy is going to be a good place for an investor that doesn't want to participate in this bubble, or at least wants to avoid the most expensive stocks. Both the large cap and the small cap strategies have roughly half the PE. Excuse me, the small mid cap strategy has about half the PE of the Russell 2000 and the Russell 2500, and then the large cap strategy is about 15% cheaper than the S&P 500 at the moment. And we're going to keep that discipline, and that's what those strategies are for. They're for investors that want good, consistent, strong dividends and financial performance. So thanks for listening. If you have any questions or comments, leave them down below. You can subscribe, and I'll catch you on the next one. Thanks. Bye.